Thank you for the kind introduction, Natalie. First of all, I would like to welcome all of our online participants from around the world to the online DeFi edition of the Conference.Exchange. My name is Esfandiar Lagevardi. My friends call me Essie. I'm a full-time liquidity provider, investor, digital asset trader, and DeFi contributor in the space. Unfortunately, due to illness, Valentino Cremona was unable to moderate today's crypto trading and panel discussion. So hopefully it's nothing too serious and he recovers very quickly. Therefore, I will take on the role as the moderator today. So with all due, the aim of today's crypto trading and panel arbitrage panel discussion is to give the viewers at home a good insight into the profitable trading and arbitrage opportunities and techniques that have emerged with the proliferation of DeFi over the last 12 months. So, as well as point out maybe some of the risks that traders, investors, and liquidity providers are faced with when trying to manage and deploy their risk and capital exposure within the space. So, I've prepared an agenda for today's panel, which should last around 40 minutes. And if any of the viewers at home have any questions, please do not hesitate in posting questions in the chat so that I can collate them for a Q&A session towards the end of the topics of discussion. So moving on, I know Natalie's given a slight introduction to our panel members, but it would be a great honor of mine to introduce Eugene Lazar. Eugene is the chief executive of Esfandiar and is currently very involved in working in the DeFi space. Esfandiar is an Ethereum-based on-chain automated market maker that uses liquidity reserves to minimize the trading costs, pricing discrepancies, and slippage within the crypto exchange market. Eugene also has a very long history and proven track record in the crypto and finance industry as an accomplished analyst, trader, and investor that has made several good bets to date. Furthermore, it's a pleasure of mine to introduce Michael van der Pot. Michael is the founder and owner of Bonsanka Crypto. It's an online coaching platform specializing in educating investors and technical analyst traders on how to assess market sentiment and price movements accurately. And Michael is also very well known for his regular contributions in publications and platforms such as Cointelegraph, Crypto Benelux, and his TradingView posts, where he shares a lot of technical and market-based analysis and posts to his followers. And last but definitely not least, it's a pleasure of mine to introduce Eleni Simon. She's a graduate from Yale. Eleni has a long, distinguished career spanning across finance and banking, management consultancy, and strategy and operations. And he currently heads up the strategy and operations at Bloxroot Labs. And she's also very well known for her crypto blog and posts. So definitely check that out on eleniThinks.com. And she's also a contributor at ChicagoRelayNode.substack.com. So, please have a look at that. So Natalie and Anna have done a great job in putting a very accomplished panel of speakers together. So without further ado, I would like to kickstart the panel discussion and debate. And I've prepared a few questions in advance, which I'm confident will hopefully lead to a very informative discussion between our panelists and for the viewers at home. So the first topic that I prepared and I'd like to discuss is how the emergence and proliferation of DeFi assets and protocols have really impacted and changed the way that traders and liquidity providers like yourselves deploy capital in the space. So Michael, if you don't mind kicking off the panel discussion, that would be much appreciated.
To be honest, it didn't shift too much, as I'm a very technical trader, through which I'm not really into all that like liquidity providing stuff. So maybe one of the older members of this panel do more with it than I do. The only thing that's changed is that the overall sentiment of the market has shifted from Ethereum solely towards other platforms. So therefore, you've got a completely different market sentiment. But it didn't change my way of trading at all. So,
how about you, Eleni? Have you noticed an impact in the way in which you approach trading or approach buying or selling different types of financial instruments in the space?
I definitely think it's increased the competition. Now you need to have, run multiple nodes in multiple regions, make sure you're really well connected to the network. And arbitrage opportunities are becoming much more fierce to capture those. So with more money, it definitely just means people are investing more into building better bots and chasing yield. And so I think the competition will just get steeper, and eventually we'll be somewhere with traditional finance where a nanosecond of trading is the type of edge you need to win.
Yeah, the reason I asked is because as a trader myself, I've noticed that a lot of the volume that I conduct buying and selling digital assets has was moving more and more towards DeFi, towards DEXs, towards various different types of LP tokens that I can trade into, and also not only make money on the appreciation of the underlying token itself, but also make money on potentially on the yield farming rewards or the exchange fees on the underlying LP tokens. So I would like to hear your opinion on it, Eugene, if you don't mind.
My trading strategy is not changed in traditional market, in traditional crypto market, but DeFi it's something new, and of course I try to be a liquidity provider on our platform, in other platforms, but I see this industry will grow, and another instruments will continue development, and I see potential in this area. Something like
that. There's a follow-up question. What are the next generation or new types of financial instruments that excite you, Eugene?
Yeah, for sure. Also, we will add synthetic assets in our platform, and now you can trade already with SpaceX shares, not shares but synthetic assets, and it's interesting. That's why I see potential.
Yeah, I'm a big fan of Mirror Protocol. I'm not sure if you've heard of it. It's a synthetic asset protocol which enables you to deposit collateral and then mint synthetic assets that are in essence pegged against the collateral that you provide, which allows you to gain the potential for adding exchange revenue as well as yield farming rewards to traditional assets like stocks, for instance. So as a follow-up, what part of the DeFi ecosystem do you think will be the most profitable to be in? So what part of the ecosystem do you think will generate the most alpha? A lot of people are very excited about DEXs, some are very excited about vaults, some are very excited about lending and borrowing platforms, insurance protocols, etc. So what part of the ecosystem are you most excited about, and do you think has the best risk reward or profit potential for new or less experienced investors or traders that are entering?
Did you say Eleni? Me? I think
yes, I did.
Yeah, I think that the answer changes with time. In the short term right now, we are seeing the protocols that are providing power to their users in the form of governance tokens or yield farming are for sure the most profitable. But I can't see that lasting forever. I mean, we saw SushiSwap come in and take demand from Uniswap, and I'm sure there'll be the next generation of comp and different automatic market makers that continue to fight over that market share. And so it'll keep moving, but as we build more of the financial Legos that you need to actually get to an end customer use space, something I'm excited about in the long term are NFTs, but not necessarily art, but in terms of digitizing digital ownership. So it's, sound bites, it's logos, it's the different widgets that can interact with a larger consumer base. And I think maybe in 5 to 10 years, the majority of yield will go towards those type of.
That's very interesting. How about your opinion, Michael? Where do you think the most, profit is to be had in the space? Just trading market movements, or do you think there are other I guess, areas of the space that potentially interest you?
Well, definitely in the short term, it's the more lucrative and complex some protocol is, the more revenue you can make out of it. And that's what we see right now. You've been discussing it with all those LPs that is currently happening, which is not benefiting any of the retail end customer at all. As like we are already having a discussion on that topic, and I'm having a hard time understanding all those stuff either myself, and I'm a professional trader. So I think the overall concept of NFTs and making an ecosystem that is fully DeFi and we don't need any banks at all, that settlement where the end user doesn't know that they are using blockchain, that's where the actual revenue is going to be made, as that's the big end game. So I'm more focused on the entire ecosystem with DeFi, oracles, NFTs as well, but then I'm more about tokenizing value instead of the art and all the collectibles that's going around right now. That's going to be big as that's integrated into DeFi. I believe that that's going to be something that we have to work to rather than focus on making the highest amount of yield farming, because that's just some financial instruments built for the short-term game. And the end user will never, ever use that at all.
And Eugene, do you have anything to add to the debate?
No.
Okay. So I guess the next question would be, as someone who's been around the digital asset space for some time, a concerning observation that I've been making is that many new and established participants within the DeFi industry simply do not fully understand a lot of the risks, or even are able to comprehend a lot of the risks that they are taking. So what suggestion or tips and tricks do you guys have in identifying red flags or techniques that help you, I guess, assess or measure the risk that you're taking? Michael, if you don't mind kicking off the...
Well, it's funny, like the more retail that's going to jump into the markets, and I speak with some of them, the first question I get is, what do you think about Ripple, for instance? That's literally the first question that I get, and not about the opinion that I have on XRP or whatever, but you have to read and understand the assets that you're really trading. And next to that, make it simple first. If you don't understand Bitcoin, don't try to understand DeFi. If you don't understand Ethereum, don't try to understand liquidity pools. So try to understand the assets itself. Trading just regular markets is risky at first. And then when you go to Uniswap or to SushiSwap to swap some tokens into liquidity pools, that's just another level. So just keep things simple. Don't listen to all the noise. Like 99% of the stuff that's on social media is complete garbage. Even MSM media is complete garbage. So just make it for yourself, make it simple, and make a long-term plan. So like low time preference instead of high time preference, and start building from there onwards instead of chasing that 50K API percentage liquidity pool. That's just not going to work out. So yeah, that basically is.
Yeah, I totally agree with you, Michael. I've had similar experiences where a lot of friends of mine have been sending me screenshots of a new farm with 10,000% plus APY. And I think a lot of the misunderstanding is that a lot of these newer investors actually think that they will be able to get risk-free returns, or somewhat risk-free returns, of a 10,000% interest, when they don't realize that the APYs are unstable. And the reality is that no token that pays out 10% APY will be able to sustain that, rate of inflation without severely debasing the token that they're paying out the rewards in. So it just undermines the whole principle. I remember a friend of mine, he sent me a farm that he was in that was paying him 3,000 or 4,000% APY in the native governance token that he was farming. But given that they were the protocol that he was in was also paying out numerous other smart contracts and vaults, the reality is that even though he was getting thousands of percent in interest, he was actually getting a negative APY because all of the other rewards that the protocol was paying out to other smart contracts, he wasn't receiving. Thereby, these other rewards were debasing him at a faster rate than the interest rate that he was getting. So I think it's really important for investors at home or newer traders in the game to really try and wrap your heads about what is real APY and what is kind of a fake or unsustainable APY. So if someone's offering me 5% in Bitcoin, I'd much prefer that than if someone's offering me 1,000% in a very highly speculative token that is being paid or funded through the debasement of the token itself. So just as a follow-up, Annie, what is your, opinion on the matter?
Yeah, I mean, the first thing you learn in finance is the relationship between risk and reward. If you're getting a 10,000% APY, like, you should be asking yourself why, and it's likely because it's such a risky investment that they need to offer such a high return to entice investors to put their money there. But on a more practical level, I think there's three things I tend to look at in any project. Like, first, what's the protocol risk here? You know, is this contract audited? How long did the team spend trying to develop? You know, what's their debugging process? Things like that. And then the second is, like, who built this? If it's a team that you know and trust and has built protocols in the past that have been successful, you know, it de-risks a bit the fact that they're invested in the success of their product. And then the last is, you do want to look at who else is involved. You know, for better and for worse, having VC funding does signal that this is a serious project that does have long-term horizons or long-term look of their product success, because that's what a VC will demand. And so maybe you lose on some of the APY because a VC comes in early, but it does de-risk the investment, and you're probably less likely to lose your money because there's a protocol glitch.
No, I absolutely agree with all of the points you made. I think it's a great indication, based on who's already involved in the project, how much due diligence and, attention to detail has already been, directed at the project. And if, a newer project is able to withstand a lot of the due diligence and tough questions that established VC has in the space, with some, more established participants in the space, then most likely that project has a much higher probability of succeeding than projects that, you don't, do significant due diligence there. So, yeah, I absolutely agree with Eleni. As an investor or trader at home, it's really important to try and assess as many technical risks as well as financial risks before deploying money in the space, because it's very, very easy to spend money to a wrong contract. But moving on, a very interesting topic that I would like to discuss is how to try and navigate the dark forest, so to speak, or the public mempool, because as a trader that's moved a lot of his volume from centralized exchanges to decentralized exchanges, I guess one of the advantages of centralized exchanges is that no one is able to see the order flow before the orders are settled. Unfortunately, with public blockchains or trading on public blockchains, you need to issue your transaction or your unconfirmed transaction into the public mempool, so that, in other words, other actors within the space can see your trading orders ahead of time. And the problem with that is that it gives the rise to the possibility of traders trying to front run you, or program bots trying to front run your trades. And this is a problem, unfortunately, that I'm running into more and more now. What is your, opinion on it, Michael? And what solution, or, I'm guessing because you're still a very technical trader, does that even affect you, given that I'm guessing a lot of your trading volume is still on centralized exchange?
Yeah, there's like pros and cons for both, right? So there's the pros with centralized exchanges, that you can go somewhere if something goes wrong. You can see the order flow. It's all pretty transparent, but like in some way transparent. It's not, but it's some way transparent. While in DEXs, you've got gas fees with Uniswap, etc., being extremely high, or the problem that you've discussed. I've chosen to minimize my risk through having centralized exchanges and using them still, as I don't see that DEXs are way better than centralized exchanges at this point. So I try to avoid to go into the rabbit hole and into that like big basket of all tech geeks playing around and just stick on the centralized exchange, simply also because it's quite hard for me to educate people with Uniswap stuff and let them go there. For a risk approach, newcomers, I don't want to push them towards a DEX. Let them first understand how to work with a SEX and how to work with those tradings and the volatility in general. And then if they want to deploy some money towards the market or Uniswap, then they can go there. But they shouldn't be going towards the DEX immediately, in my opinion. So I try to avoid it a little bit.
If I could make a shameless plug, Bloxroute, and I'll talk about this in my presentation afterwards, but we actually have a product that we call private transactions that allows you to send your transaction directly to a miner who is not going to propagate it to the rest of the network. So it'll sit in their mempool, mine a block and include your transaction, but that transaction doesn't become public until it's included in the block. And so we've seen a lot of our customers are sophisticated traders who are doing exactly what you said. They're trying to avoid being front run by someone else that sees their transaction and steals the opportunity.
Yeah, I think that's a fantastic point. That was one of the questions actually that I wanted to ask you about. Hopefully the emergence of private mempools will try and alleviate some of those fears. So moving on, I would like to talk a bit more about the cross-ecosystem arbitrage between the centralized institutions and also some of the decentralized applications. So one of the key trends that I've noticed is that a lot of the big volume hits a lot of the, I guess, more liquid centralized exchanges first, and then you have the market starts moving on the centralized exchanges first, and then you see a lot of, I guess, arbitrageurs arbitrage a lot of these, larger liquidity pools, and that then move the price towards the movement out of the centralized exchange. So, have you noticed a similar, a similar dynamic in the market, or and do you think there will be a lot of, I guess, opportunities that emerge from these types of trends moving forward? Eugene, do you mind?
He's gone, I guess. Eugene.
Okay, well in that case, I guess I'll like to swing back to and ask you, Eleni, what's your opinion on the matter?
Yeah, I think this is related to your first question, which is, how does the rise of DeFi change things? With more participants, we are seeing markets become more efficient, and that adjustment between centralized exchanges, pricing, and decentralized exchanges is happening faster. It might not always be equal, and I think that is likely due to high transaction costs, quite frankly, on the centralized exchanges. So you might see a price that's slightly lower, but it costs you like $15 in gas to execute. So it ends up net being the same.
So as a follow-up question, a lot of people in the space have recently been talking about the emergence of layer 2 solutions, whether that be Matic, Loopring, now also with optimistic roll-ups. So what are both of your opinions on layer 2 and how that could potentially affect the trading market moving forward?
Is that to ask me then?
I mean, how do you think, do you think L2 will be able to compete with centralized exchanges, given that it lowers the gas fees, at a huge order of magnitude?
Well, it's a few different topics that you're asking there. Like initially, it reminds me a lot about the start of this entire crypto space, in which we also had big arbitrage between Bitfinex and Binance back in the days when there were still only a few centralized exchanges. Over time, that decreased because of new exchanges were coming into the markets, through which that market became efficient. Then you've got the discussion between which is leading, futures or spot, but that's a completely different one. And now we've just got the first stage of DEXs coming around, in which we just have a few of them, and there's still lots to gain there. As in, the market is inefficient, which means that there's still a big gap and there's still arbitrage to be made out of there. And once second layer solutions are going to kick in, the transactions are going to be faster, through which also the fees will be decreasing, which makes it easier for new participants to join with a new DEX to make the market more efficient. So I think it's going to be beneficial for the markets in itself, as we are still in a very early stage of DeFi in general. But it just takes time. It's the same with NFTs. It's just going to take time.
If I may have another shameless plug, Blockcrowd, our mission is to scale Ethereum, and we want to do that at the networking layer, which scales level layer 1, like the actual layer. And I think in this world, the demand is so much bigger than the supply of additional space that we can provide and layer 2 can provide. And for any layer 2 to be successful, it's dependent on a layer 1 that scales. And so we see that, you kind of need everything, throw everything at Ethereum to make sure that it continues to be the place that people go for DeFi, because we are seeing competition from, Polkadot and Cosmos and other chains that are getting onto the DeFi, into the DeFi game. And, if layer 2s don't come soon, I'd be afraid that a lot of that value will move elsewhere.
Yes, I'm getting very similar feedback from my friends and contacts in the space that there's only so much gas that they're willing to, or gas costs that they're willing to accept. And it's getting to a point now whereby they are informing themselves and learning themselves about the different options and availabilities that are coming to the market, whether that be Polkadot, whether that be ADA, or a couple of other of the smart contract platforms. So we got a really good question from one of our viewers, and from YouTube. His name's, or her name is Crayfish, and their question was, they're really worried about DEXs, and given that there's no KYC requirements, and there's a huge, I guess, concern of money laundering and terrorist financing amongst regulators around the world. So, given the amount of money that's moving around the DeFi ecosystem, are there any particular compliance risks that newer traders or investors should be aware of, going forward potentially throughout the next 6 to 12 months? Eleni?
Yeah, I think that this question must be someone who's sitting in the US, because we're a lot more concerned, I think, than people in other countries. And I would take it into the perspective of how big of a player you are. I've heard we're a Chicago-based company. We know a lot of the Chicago traders, and they've been jumping through hoops to be able to trade on DEXs because they can, for the exact reasons that you've described. But if I trade on a DEX, I don't trade much money. I think chances are the US government isn't coming after my $100 that I'm trading, but it's for sure a risk. And if that makes you uneasy, I think you should probably then trade on centralized exchanges that do KYC. I think in the future, and we've kind of seen a glimpse of this, the US government has threatened to limit on-ramps. So they've made threats about getting rid of non-custodial wallets, which like MetaMask, a way that you can interact. And we might see MetaMasks in the future ask for KYCs. They're a US-based company. That's how the government works here.
Yeah, that would be very nice. So, Michael, from a European point of view, do you notice a big difference between, I guess, how the North Americans are approaching compliance issues and risks, and how many European actors within the space are doing the same?
Well, I guess it's quite similar. I'm in the Netherlands, and we are not really user-friendly over here, as there's all those restrictions coming into exchanges and KYC and making it very difficult, especially through the fiat gateway, right? That's the whole point. So what we're currently seeing, in my opinion, is that they are building systems through which they can get to crypto through that KYC policy. So they are making it more transparent. The regulatory framework is being built. That's being built for CEXes and for crypto in itself. The next layer is DEX, which is way more complicated to make a regulatory framework for, so big institutions can jump into that. So it's more like a retail thing right now, as there's not many problems for retail to trade on DEXs. However, if you make a few 100K in it and you want to cash it out towards fiat, how are you going to show that it's not terrorist money or anything else? So that's just completely different topic, and that's just another stage after the stage we are currently in. We first have to settle down with the first regulatory framework, and then we can move forward. And that we're currently in that stage, I believe.
Yeah, I absolutely agree with you. I think that's a fantastic point. The reality is that as a trader, investor, or participant in the space, there's a lot of, I guess, new innovations that simply regulators do not fully understand or not even aware of yet. And as a result, it's very difficult for you to anticipate how regulators or various different regulators around the world will compete against each other, given the regulatory arbitrage that's going on.
Well, in general, like, tech is just accelerating so fast while the law is just being behind heavily. We are currently in a discussion in the US whether privacy is real or not, and how are those tech companies going to defend your privacy, right? With Facebook and all those big guns being there. That's a topic that's 20 years old and we're still discussing it. So imagining that those governments are able to make regulatory frameworks for the DEX is just a fairy tale. They are not going to be able to do that within the next few years. So that's something that's very difficult, as technology is just accelerating in such a pace that they can't keep up.
So I guess as a follow-up, my question would be, as a new trader or user in the space, what should my approach be? Because a lot of actors are in the space. If you look at, Binance, they've been able to establish significant market share by, playing within that compliance gray area or managing their compliance risk, quite well in comparison to other actors. So, Annie, what's your opinion on that?
I think
the regulatory gray area as a new participant in this.
I think this goes back to our conversation about like risk reward, and you need to think about how much risk you're willing to take for a given amount of reward. So the first place, as Michael said to start, is like a centralized exchange, and you need that on-ramp anyway to get whatever your fiat is into crypto. And as you get more comfortable with interacting in crypto, I think DEXs and even using centralized exchanges outside of your country. So, in the US, the biggest ones are CoinList, Gemini, and Coinbase. You can do more sophisticated trading, but now you're taking on more risk. And so I would say, start at the beginning, start with a centralized exchange that does KYC.
Yeah, for sure. I agree. Well, first of all, I'd just like to thank my fellow panelists and participants for their great insight and feedback on the panel discussion. And also to Natalia and Anna for organizing the conference. And I think from our side, I think we're pretty much done. I think we've pretty much ran out of time now. So cheers, everyone. Thanks for your time. And hope everyone.
Guys, thank you very much.